Across the United States, tens of thousands of nearly new SUVs are being handed back to lenders, not because they broke down, but because their owners can no longer afford to keep them running. 340,000 of these vehicles were voluntarily surrendered in the first half of 2026 alone, a number that has never been recorded outside a recession. B-roll note: wide shot of a repossession lot, rows of late-model SUVs under fluorescent light. These aren't old, worn-out vehicles. The average SUV being surrendered is just 19 months old. B-roll note: close-up of an odometer reading under 20,000 miles. Outside Knoxville, Tennessee, a construction foreman signed the papers on a mid-size SUV in 2024. 18 months later, he handed the keys back voluntarily, walking away from the vehicle rather than pay what it now cost him each month. B-roll note: silhouette of a man in work boots walking away from a dealership lot, no face shown. By the end of this video, you'll understand the one-number dealerships and lenders have been quietly hoping you never add up. This is not a story about a few unlucky buyers. It's a story about a structural shift in the cost of owning an SUV that has been building since 2022, and it is now hitting 4.1 million American households at once. B-roll note: map graphic of the U.S. with density clusters over Sunbelt and Midwest metro areas. The foreman in Tennessee financed his SUV at $612 a month. That number never changed on paper, but the real monthly cost of keeping that vehicle on the road climbed to $1,140 within 2 years. Insurance, sensor repairs, and a loan balance that grew faster than the vehicle's value shrank. B-roll note: split screen graphic, 2024 monthly cost versus 2026 monthly cost. He didn't miss a single payment for 14 months. Then a single repair estimate, $3,800 to replace a windshield-mounted camera system after a crack no bigger than a coined real, made the decision for him. He called his lender the next morning and asked how to give the vehicle back. B-roll note: insurance repair invoice, camera and radar sensor components visible on a repair bench. The system behind this isn't a single villain. It's 3 industries that don't coordinate with each other, but whose incentives point in the same direction. Lenders extended loan terms to 72 and 84 months to keep monthly payments low enough to close the sale. Automakers built increasingly sensor-dependent safety systems into every trim level, not just the luxury ones. Insurers, facing the real cost of repairing that technology, raised premiums to match, regardless of the driver's record. B-roll note: 3-panel graphic, lender/automaker/insurer icons converging. Each of those 3 decisions made sense on its own. Together, they built a trap most buyers walked into without ever seeing the door close behind them. But this is only the surface layer. To understand how this happened, go back to 2021. Interest rates were near zero. Automakers were racing to add driver assist technology to justify rising sticker prices. Nobody was thinking about the repair bill 5 years out. They were thinking about the sale. B-roll note: archival-style footage of a 2021 auto show floor, ADAS marketing displays. By 2023, nearly every mainstream SUV sold in America carried at least 8 cameras or radar sensors as standard equipment. That was marketed as a safety win. And it was, collision rates dropped, but nobody marketed the other side of that equation. B-roll note: diagram of sensor placement around an SUV body, front, rear, side mirrors. A cracked windshield used to cost $250 to replace. Now, with a camera calibration system built into the glass, that same crack costs $1,600 to $4,000, and it has to be done by a certified technician, not a corner shop installer. B-roll note: technician recalibrating a windshield camera with diagnostic screen. 3 words: recalibration isn't optional. Insurers noticed first. By 2024, comprehensive insurance premiums on SUVs with advanced driver assist packages had risen 34% faster than premiums on comparable sedans without them. Lenders noticed next cars, but by then, millions of buyers were already 3 years into loans built around the old numbers. B-roll note. Line graph, SUV insurance premiums versus sedan premiums, 2021, 2026. Then came the second blow. As automakers pushed out 2025 and 2026 model years, resale values on 2023 and 2024 SUVs dropped faster than lenders had modeled. Buyers weren't just paying more each month, they owed more than the vehicle was worth. B-roll note. Depreciation curve graphic, steeper than projected line. That's negative equity, and it's the quiet engine behind almost every voluntary surrender happening right now. But here's what most people get wrong. Most people assume this is a story about bad borrowers, people who bought more SUV than they could afford. The numbers say otherwise. The average household surrendering a vehicle in 2026 has a credit score of 721, solidly prime. These are not high-risk buyers. They are ordinary, credit-worthy Americans who financed a vehicle using the same math that worked for a decade and got caught when that math quietly stopped applying. B-roll note. Credit score distribution chart of surrendering households. Here's the full stack of numbers, laid out the way a lender never will. The average SUV loan balance in early 2026 sits at $41,300. The average trade-in or resale value of that same vehicle, $29,800. That gap, $11,500, is money the owner owes on a vehicle they no longer possess. That's more than a third of the median American's annual take-home pay, gone, for a vehicle sitting on a lender's lot. B-roll note. Bar chart. Loan balance versus resale value. Gap highlighted in red. Add the insurance shift. The average comprehensive premium on a sensor-equipped SUV is now $2,340 a year, nearly $900 more than the same buyer would pay on a comparably priced sedan. Over a 6-year loan term, that's over $5,000 in insurance costs that never appeared in the original purchase conversation. B-roll note. Insurance premium comparison, SUV versus sedan, annual and 6-year totals. Now add repair frequency. DAS-equipped SUVs are involved in minor collisions at a similar rate to any other vehicle. But the average repair cost per incident is 2.6 times higher because a bumper tap now means recalibrating a radar sensor, not just replacing plastic. B-roll note. Side-by-side repair invoices, standard bumper repair versus sensor-equipped repair. Here's the counterintuitive turn. The safety technology that was supposed to protect these buyers financially, lower collision rates, fewer serious accidents, is the same technology quietly pricing them out of ownership. The feature sold as a benefit became the largest hidden line item in the entire cost of the vehicle. B-roll note. Slow push-in on a dashboard ADAS warning icon. The lending industry saw this coming as early as 2023 and said nothing because rising loan terms were still closing sales. For the foreman in Tennessee, the math was simple and brutal. $3,800 for one repair, against a vehicle worth $11,000 less than he owed on it. Walking away wasn't recklessness. It was the only rational decision left on the table. B-roll note. Return to the earlier silhouette shot, now signing surrender paperwork. If you've ever looked at your insurance renewal and felt like something didn't add up, you were right. This wasn't a mistake. It was a cost shifted quietly onto the owner, one renewal notice at a time, while the sales conversation stayed exactly the same as it was in 2019. B-roll note. Insurance renewal envelope opening, close on the new premium total. Most people don't realize that the technology bundled into their SUV as a safety package is underwritten separately by insurers the moment it leaves the lot, and that underwriting has nothing to do with how safely you drive. B-roll note. Insurance Actuarial Table Graphic, ADAS Repair Cost Column highlighted. The buyers who avoid this trap in 2026 are the ones asking a question almost nobody asked in the finance office. Not, what's my monthly payment, but what does a single sensor recalibration cost on this exact trim? That single question, asked before signing, not after a repair estimate, is now separating households that keep their vehicles from households that hand them back. B-roll note: finance office desk, contract and pen, camera holds on the paperwork. The three words that started this section, recalibration isn't optional, are now the three words defining who keeps their SUV and who doesn't. Which brings us to what happens next.
Lenders are already adjusting. Loan terms on new SUVs are quietly shortening back towards 60 months, and several major insurers have begun requiring proof of ADAS calibration history before renewing coverage. The market is correcting, but it's correcting on the backs of the buyers who financed under the old rules and didn't know the rules had changed. Dealership Finance Office, new shorter-term contract being signed. For the hundreds of thousands of Americans still driving vehicles they can no longer afford to repair, the surrender lot isn't the end of the story. It's the beginning of a credit event that will follow them for the next 7 years, for a decision they made believing they understood exactly what they were buying. Final wide shot, repossession lot at dusk, gate closing.